You're welcome.
Hey guys, I'm Mitchell Kopelman with Win, or HA&W, whatever's easier for you. And appreciate joining you here this morning out at the Alpharetta ATDC location. So what I want to talk a little bit about are some of the financial reporting requirements that are currently expected to be required under the crowdfunding legislation. So if you're going to raise $100,000 or less, which some companies at the very early stage, that's really all they're looking for. The only thing you have to provide to the community that you're soliciting to raise money are income tax returns and financial statements. It says today certified by a principal officer. So you don't have to have we're a CPA firm, you don't have to have our CPA firm, Win, actually sign off on what's called compiled, reviewed, or audited financial statements to raise $100,000 or less. It's very, very simple. It's your own financial statements, your own tax returns, whether you prepared them or a CPA firm prepared them. It really doesn't matter. If you're going to be between $100,000 and $500,000, you have to have what's referred to as a reviewed financial statement, which is by a CPA firm. So our CPA firm audits financial statements, we compile them, and we review them. And those are 3 levels of financial reporting attestation. That's essentially been involved in the accounting industry for decades now. And you'll need that if you want to raise between $1 and $500,000. More than $500,000, but less than $1 million, you'll actually need audited financial statements. So, but that's it. It's not all the other requirements. And there's a lot of legal issues that are involved here that I'm not going to get into, not being an attorney. But if you went to an attorney today and said, I want to raise money from people in 20 different states and I want to publicize this offering to 100,000 people that have liked my Facebook page or have downloaded my app, they're going to say, oh no, we've got all kinds of securities issues that you're going to violate. You can't do it today. So these rules really relax, or the rules once they're codified are expected to relax a lot of what exists today that restricts you from really even crossing state lines or soliciting more than, I don't know the number in Georgia, it might be 50 people without having a lot of disclosure of information. So some of the pros, though, as I've already mentioned, are that companies can tap into, again, a larger pool of investors. You've got people all over the world that you can actually solicit. You're not limited to the United States by any means. And you may attract more sophisticated investors, but I think you'll also attract a lot of unsophisticated investors. You'll have to have, if you want to target that higher capital raise under the crowdfunding, you will have to invest in having audited financial statements. We have a lot of clients that raise $500,000 to $1 million in their first angel round or Series A. They don't need audited financial statements to do that today. Most experienced investors, prior to your first preferred round of capital, they're going to say, hey, we don't need you to have an audit. We'll require one after we give you the money. But for now, we just want to come in and get comfortable with your financial records. So there are some additional costs that you would have to incur. One of the big negatives is you could go from having a handful of shareholders, some founders, to having a lot of investors investing things like $1 million increments. I mean, you could, of course, set your increments, no one less than $5,000, but you have a lot of people investing just $1,000. And so you could end up with hundreds of investors all over the country, all over the world, that you now have to keep up with. And so that's a con. One thing that we've talked about with a lot of clients that are contemplating this, again, once it becomes legal, available to actually use, is instead of selling voting stock, sell non-voting stock. So at least if you're going to have 500 shareholders, each contributing or investing $5,000, they're not voting. I mean, you have to deal with them as shareholders. You have to comply with them if you have corporate actions that require shareholder vote. If you go out to raise institutional capital, one of the biggest problems you could have from a potential investor in your company, professional investor especially, from a venture firm, or a complete buyout of the company, you're going to have to keep up with all your shareholders. And if you don't, it could kill a deal. However, if you do keep up with them, I think that would be great. You'll have to keep up with them. It's a job all by itself, is keeping up with hundreds of, I've seen M&A deals die because they could not find shareholders. Yes, Dale?
How will this
affect things like the angel investor tax credit? You know, it opens it up to a bigger crowd of people, no pun intended here, but it also it should be balanced out like the angel investor tax credit. How will those two kind of marry here in Georgia?
Sure. Well, this is obviously a federal law, the Jobs Act, and the angel credit is Georgia. There may be other angel credits, but we're dealing with Georgia, okay? So the question is, what will happen to the angel credit interfacing with the Jobs Act? So simple answer is, if your company, prior to raising capital, applies for the angel tax credit, fills out the application we've provided today, if you haven't already done it, and it comes back and it's approved by the state, if you have that in place, then you can tell on your crowdfunding communication that for Georgia investors, you're eligible to receive the Georgia Angel Tax Credit. We're an approved company. We meet the requirements today. You have to continue to meet those requirements 2 years later, some requirements, not the same to qualify. And so they could then apply and get that angel credit. So there's not a minimum investment to get the angel credit. There's a maximum, but not a minimum. So it's a benefit that you can publicize. Yes.
But do they have to be accredited investors to qualify for
yes.
the angel tax credit?
The angel tax credit says you have to be an accredited investor. Yeah, good point.
So the crowd that's not an accredited investor,
they won't qualify. Right. Doesn't prevent you from communicating that this exists, and the accredited investor rules are national rules, and they've changed a lot over the last couple of years. It's actually, in a lot of cases, some people that might have been considered accredited might not be considered accredited today. But that's their decision and their claim. It's not your responsibility. So let me come back to another, not necessarily a con, but a strategy around the crowdfunding. The other thing that we've recommended to some clients that are considering this in the future, in addition to non-voting stock, is actually selling redeemable stock. So you could actually have almost like a preferred redemption, but it's at the company's option. So let's say you raise $500,000 through crowdfunding in 2013 when it becomes legal, assuming it becomes legal by 2013. We don't know when it will. So let's say you do that, and then in 2014, you've got an investor that wants to invest $5 million of venture fund, and they say to you, listen, we don't mind that you did this crowdfunding. It's great that you were able to raise this $500,000, got you to where you are today. However, we don't want to have 500 shareholders. We just don't want them. So they're going to want to cash them out. And you want to consider having a provision in your crowdfunding proposal that says we'll, as a company, have an option to buy you out, maybe at a certain price, maybe there'll be some type of liquidation amount that you could actually say, it's almost like I would say it's like a preferred return. And you might say, you know, we have the option to pay you back with a 10% return, you know, within 2 years or 3 years, or at any point in time. You could build in different mechanisms. It's up to you how you want to structure it. Of course, people may not want to take the risk if you limit their upside. So I think that's where why limit the risk? But it's something to think about, that you might want to craft something that gives you that ability, or maybe you're just going to buy them out at the same rate that this investor's coming in. So if you're raise money from crowdfunding at a $2 million pre-money valuation, but now you're doing a Series A round at a $20 million pre-money valuation, maybe you have the option to buy them out at the $20 million valuation. Or maybe you can get a third-party valuation from them and rely on that. So you could build some mechanisms. It's still unclear what you'll be able to do, but it's something to think about to go down the crowdfunding route, because you really might not want to have these shareholders down the road, and a professional investor may not want to have them. I mean, you could definitely in other words, rather than raise money in your company, you could form yourself with maybe one of your other founders a new LLC that's going to own 5% of the company. If that LLC invests, let's say, $500,000, and then you can go out to the job funding sites, which I think these sites up here will become avenues, or they'll have sister sites. You know, Kickstarter will have Kickstarter under the Jobs Act and Kickstarter not under the Jobs Act, which is essentially not selling equity. And I don't see why you can have a special purpose entity, a LLC in this case, or a corporation that people would invest in that would be different from the main company, it's a marketing issue. Will people be comfortable investing in this company that's going to become a shareholder in this company versus investing directly?
Right.
Well, on behalf of Hey Beferi Getting Win, I appreciate you guys giving me the time to come out here and speak to you.
Thank you.
You're welcome.